Welcome to the Agent of Wealth podcast with Mark Bautis from Bautis Financial. In this podcast, Mark helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Mark draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth podcast. This is your co-host, John Williams. And today we're going to be talking about one of the most common questions I get from clients, especially over the last few years, is this. I have a lot of equity in my home. How can I actually use it? And it's a great question because for so many people, their home is their largest asset. They've been saving in other areas, particularly retirement, which brings up liquidity issues. There's penalties and issues with getting money out of retirement funds. So they look to their home, and maybe they've been lucky enough to build up a lot of equity in their home, and they want to know how to access that. The other side of that is just because you can access that equity doesn't always mean you should, or that you're necessarily using it for the right strategy. So today we're going to take a deeper dive into that. We're going to go a bit into what we'll call a mini masterclass on home equity. Today I'm going to walk you through three of the most common ways to access your home equity. First, home equity lines of credit, or what are sometimes referred to as HELOCs, home equity loans, and cash refinancing. We'll talk about how each one works, when they make sense, the pros, the risks, and just as importantly, how to think about these decisions within your broader financial plan. And if you find this helpful, we've created a downloadable cheat sheet that summarizes everything we'll cover today. Of course, tell you how to get that at the end of the episode. So a lot to cover today, so just dive right in. So first, let's set a little bit of a foundation before we get into the specific strategies. The key idea here today is how can we access this home equity, but we also need to consider that home equity is not free money. It's, of course, borrowed money. And this borrowed money is a secured loan secured by the equity in your home. So anytime you tap into it, you're increasing your leverage and putting your home at risk. You're putting your home at risk, especially if things don't go as planned. It doesn't mean this is a bad idea. In many cases, using your home equity can be a very smart financial move. But it's important to know that it needs to be done intentionally. And in my experience, the best use cases tend to fall into a few different categories. Funding home improvements, consolidating higher interest rate debt. A lot of times that's credit cards with interest rates as high as 20% or even higher. Covering large planned expenses, or simply just creating a liquidity buffer for flexibility. And where people get into trouble, though, is they treat this home equity almost like a checking account instead of a strategic tool. With that foundation, let's start with the most flexible option, which is the HELOC. Now, HELOC is short for home equity line of credit. It's essentially a revolving line of credit secured by the equity in your home. I'd like you to think of this as like a credit card, but with your house as collateral. Instead of taking all the money up front, you're approved for a credit line, and you can draw from it as needed. There are typically two phases with a HELOC. The first is the first 10 years. It's typically around 10 years, what they'll call a draw period. And over this 10 years is when you can borrow from that line of credit. And the second phase is a repayment period where you pay back both the principal and the interest. Now, during the draw period, many HELOCs only require interest-only payments, which is a nice feature and offers a lot of flexibility. And it keeps that initial payment on a monthly basis relatively low. HELOCs tend to work well for homeowners who want flexible access to funds over time. So they're not necessarily on an exact timeline, and they don't need a lump sum up front. But you also have to consider whether or not you're comfortable with variable interest rates, which we'll get here in a second. So some of the most common uses are some of the things we mentioned already: ongoing home renovations, emergency reserves, or liquidity backstops. So just setting that. Sometimes you can just set that HELOC there, and without even really having a need for it. But maybe you find your emergency funds are low, and you want to have access to some quick liquidity. The other side of that too is it kind of overlaps with like the potential of like home renovations or just what might be unpredictable expenses. Like you might know you have some expenses coming up, you don't know when and potentially how much they're going to be. The big advantages here are flexibility, like I had mentioned. Yeah, you only borrow what you need. You're going to have lower initial payment obligations with that interest only. And it's often pretty fast to set up, sometimes within 1 to 2 weeks, which is nice. There are some real risks, of course, to be aware of here. Interest rates are typically variable, so payments can increase. That variable rate is going to be based off of two factors. One is going to be what is typically what they call an index. An index is going to be an interest rate that is, the benchmark that the bank will use. Many times, what they call the prime rate. This prime rate is going to move based off of economic factors, inflation, the activity of the Fed. You may hear in the news about how the Fed is looking to potentially lower interest rates currently, but obviously we can never be sure. So that part of your interest rate will actually fluctuate and move throughout the life of the loan based off of that prime rate. And then there's, of course, what the bank needs to make for lending the money. They call that the margin. And the margin is going to be set and will be static throughout the life of the loan. So just as an example, based off of your credit history and other factors, the bank might say, hey, we're going to set our margin at 2%. And that 2%, once you sign the papers, on the loan will stay the same. And then the index will be the variable portion of that. Other risks include temptation to overspend. It seems like it's available money, so why not? And this, as you can imagine, this temptation is real a lot of times with like credit cards. Hey, I really want this. We'll worry about it. We'll spend the money now and worry about it later. And then one of the other issues I see is repayment shock. After the end of that 10 years, if you borrowed a large sum of money, that payment will then, once it amortizes at the end of those 10 years, is a higher payment than they thought may have led to. So you get to that end of that 10 years and all of a sudden you have principal and interest, and it can significantly increase your monthly payment over what was originally just interest only. And it's also worth noting, in certain situations like a decline in home value or financial changes, a lender actually may reduce or freeze your HELOC access, which can be certainly surprising to some. Next, let's talk about home equity loans. This is a much more straightforward structure. Instead of a line of credit, you receive a lump sum up front and you repay it over time with fixed payments and a fixed interest rate. This option tends to work best for homeowners who need a specific amount of money up front. They want more predictable payments for planning, and they don't want to refinance their existing mortgage. They maybe find themselves in it, much like those who look to a HELOC. They don't want to blow up their current, what could potentially be very low interest rate on their current mortgage. Like HELOCs, typical scenarios include debt consolidation, major one-time purchases, large home improvements. And the key benefits include fixed interest rates, like I had mentioned. So once you sign the papers on that second loan, the interest rates are fixed. This lends to predictable monthly payments, which would be easier for planning. And it just makes it a little bit easier knowing exactly what that payment is going to be, easier to plan around cash flow and understanding what your monthly cash flow would lead to once you add this second load to the picture. The trade-offs include interest rates are often higher than first mortgages. So since this is a second lien, those interest rates are going to be much higher than what you might get in a conventional 30-year first mortgage. Payments start immediately, so there's no interest-only period, and it can create more pressure on the monthly cash flow because of these higher payments. Also, the setup can typically take a bit longer than HELOC, around 2 to 4 weeks, and underwriting is moderate. It's not going to be as long as a traditional loan mortgage, which we'll get to here in a second, but a little bit longer than a HELOC, around 2 to 4 weeks. Now let's move to our third option, which is a cash-out refinance. Well, the one fundamental difference between all of these is, instead of adding a second loan, you're actually replacing your existing mortgage with a new larger one and taking the difference in cash. So you're taking one large loan to cover what you need and to pay off your old mortgage, and now you have just one new loan, and then you take the difference between what your new loan is and what you owe on the house, and that would be the cash that you would use. This tends to work best for homeowners who already plan to refinance. So let's say interest rates are on the move down from where you currently are, and you potentially want to adjust your interest rate or loan terms and access the equity at the same time. So there's a consideration for, just like the other loans, if this is one that we have, because if those are listening maybe far off into the future when we recorded this, we find ourselves in a time where interest rates are much higher than they have been in the last 5 to 10 years, or even up to 15 years. So many find themselves with lower interest rates. But if you do find yourself with a higher interest rate, you need some cash from your equity, and the current interest rates are actually lower than what your current mortgage interest rate is, then this may be a good option for you. Common uses are debt consolidation, large expenses, home renovations. And the biggest advantages often here are often to lower interest rate compared to your current interest rate, or compared to second lien options, looking at all the first two options, and it may just be a better option across the board. And then you have a single monthly payment instead of having multiple loans to pay down. It just simplifies your leverage. But there are also some important considerations. You may be increasing your total mortgage balance. In most cases, you are. Your monthly payment may increase as well. You're resetting your loan terms, which can extend how long you're going to owe this debt. So maybe you've been paying off your loan for 10 years and you're down to 20 more years. This will reset. Typically, if you're going to go be looking at that 30-year option, all things being equal, and of course you could opt for a 15-year, but there's a potential for extending where the length of the loan from where you currently are. With a cash-out refinance, the closing costs are going to be moderate to higher, or definitely higher than the HELOC and second mortgage options that we discussed. And like I had mentioned, this typically takes. It's going to take a lot longer than the second mortgage and the HELOC, 1 to 2 months underwriting, and money running is typically going to be more expensive in this case. I think it might be helpful to lay out a couple of scenarios, the real life scenarios, or examples. And let's say I'm working with a client, we call them John and Lisa, and they have a low fixed rate mortgage from a few years ago. Something they don't want to touch, being that it's so low compared to where they are today. But they're planning a multi-phase home renovation over the next 2 to 3 years, and total cost isn't necessarily fully defined, nor is their timeline. So they came to me asking whether they should do a cash-out refinance or take a loan. In their case, a HELOC might make the most sense. Why? Because they didn't need all of the money up front. They value the flexibility that a HELOC offers, and they want to preserve their existing low mortgage rate. So it covers all of those bases. Now let's compare that to another client who needed a fixed $75,000 for a defined project and wanted certainty in payments. The home equity loan, or the second mortgage, was the better fit. It comes back to timing. They know that they have this project, it's coming up. They know the exact amount, and it just makes more sense for them. But it always comes back to, there's not a one size fits all answer here. There's timing to consider, cash flow, the interest rate environment, and of course your broader financial plan. When you're evaluating these options, I encourage you to think through a few key questions. Do I need flexibility or a fixed amount up front? Am I comfortable with variable interest rates? How will this impact my monthly cash flow today and in the future? And most importantly, what is the purpose of this money? It's obviously your money, and no one's going to tell you how to spend it. But just looking at certain lifestyle cases, you want to be sure that this is something you really want, and you want to be able to measure that against how it's going to change your cash flow. And it's just an important consideration. Like I mentioned, every situation is different, and timing is different. Interest rates, there's gonna be different tax treatments for everybody. Lending terms can vary significantly between all these from case to case, depending on your credit history. So there's just specific circumstances to consider that could make every case different. And while interest rates on home equity borrowing may be tax deductible, that's something that I hear often. It's like, oh, this will be great, we'll get a tax deduction. It's important to confirm this with a tax professional, because it's not always the case, but you want to understand what that means for your tax situation, because it might not always be better than where you are, or the current standard deduction. So if you want a simple way to compare all of these options side by side, I mentioned earlier, we've created a downloadable cheat sheet that breaks everything down, from how each strategy works to the benefits, risks, timelines, and more. You can download that link in the show notes that we're offering here. And if you're trying to decide which option makes the most sense for you, this is exactly the kind of conversations we help clients navigate every day. We look at a home decision as it pertains to your broader financial plan. We consider your cash flow, your investments, your long-term goals, not just the loan in isolation. So if you'd like help thinking through your unique situation, you can schedule a call with us at bautisfinancial.com/call. That's B as in boy, AUTIS, financial.com/call. Thanks again for listening, and I'll talk to you in the next episode of the Agent of Wealth podcast.
Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.